Hello everyone, you're welcome to my channel Promotion for Sure. In this video, we are going to talk about credit management, which is Module D of Advanced Bank Management course. In this video, we are going to do the overall summary of this entire module: marginal costing, capital budgeting, cash budget, and working capital. Now, cost accounting system provides information about the cost. The aim is to best use of resources and maximization of returns. Cost is the amount of expenditure incurred, which is actual plus notional. The purpose is profit from each job, product, division, segment, pricing decision, control plus profit planning, and inter-firm comparison. Now, marginal costing distinguishes between fixed cost and variable cost. Marginal cost is nothing but cost of producing an additional unit. So marginal cost is equal to the variable cost if such cost does not require creation of additional facilities. So if you have to give the formula of marginal cost, it is direct material plus direct labor plus direct expenses. Now sales minus variable cost is equal to contribution. Now contribution divided by sale is the cost ratio. Now contribution is equal to the fixed cost, which is also called the break even point. So whatever amount you have contributed to set up your business, if you're able to get it, it is called a break even point. Now fixed cost divided by contribution per unit is break even units. Now this is an example which you can go through by pausing the video and you can take a look at it. Okay. Now make or buy decisions, close department, accept or reject order, and conversion cost pricing. Now what is marginal costing? Now cost volume profit analysis is reliant upon classification of cost in which fixed and variable costs are separated from one another. Fixed costs are those which are generally time related and are not influenced by the level of activity. Variable costs, on the other hand, are directly related to the level of activity. If activity increases, variable cost will increase, and vice versa if activity decreases. Now, uses of cost volume profit analysis. The ability to analyze and use cost volume profit relationship is an important management tool. The knowledge of patterns of cost behavior offers insights valuable in planning and controlling short and long run operations. The example of increasing capacity is a good illustration of the power of the technique in planning. The implications of changes in the level of activity can be measured by flexing a budget using knowledge of cost behavior, thereby permitting comparison to be made of actual and budgeted performance of any level of activity. Now, limitation of cost volume profit analysis. A major limitation of conventional cost volume PV analysis that we have already identified is the assumption and use of linear relationship. Yet another limitation relates to the difficulty of dividing fixed cost among many products or services. Now, amongst variable cost can usually be identified with production services. Most fixed costs usually can only be divided by allocation and apportionment methods reliant upon good deal of judgment. However, perhaps the major limitation of the technique relates to the initial separation of fixed and variable cost. So, advantages and disadvantages of marginal cost. Advantages that it is more efficient pricing decision can be made since their impact on contribution margin can be measured. Marginal costing can be adapted to all costing system. Profit varies in accordance with sale and it is not distorted by changes in the stock level. It eliminates the confusion and misunderstanding that may occur by the presence of over or under absorbed overhead cost in the profit and loss account. The report based on direct costing are far more effective for management control than those based on absorption costing. First of all, the reports are more directly related to the profit objective or budget for the period. Deviations from standards are more readily apparent and can be corrected more quickly. The variable cost of sale changes in direct proportion with volume. The distorting effect of production on profit is avoided, especially in month following high production when substantial amount of fixed cost are carried in inventory over to the next month. A substantial increase in sales in the month after high production under absorption costing will have significant negative impact on the net operating profit as investments are liquidated. Okay. Now, disadvantages of margin costing, you can go through it. This is one of example, how to calculate capital budgeting. Okay, these are the difficulties, methods of classifying investment, expansion and new product investment, reason for using cash flows, types of capital investment, significance of capital budgeting, facets of project analysis. You can get a PDF copy of this PPT in the description box below. I'll provide the link which you can click and download for quick revision. It will be very helpful. So what are the facets of project analysis? Market analysis, technical analysis, financial analysis, economic analysis, managerial analysis, and ecological analysis. Now, analysis includes the cost of project, the means of finance, cost of capital, projected profitability, cash flow of the projects, project appraisal. Now, this is the decision process once the new project comes to your bank. This is how you're going to appraise it. Now, method of capital investment appraisal. There are basically two methods, discounting and non-discounting. In discounting method, net present value is calculated, internal rate of return is calculated, and profitability index or benefit cost ratio. In non-discounting method, payback period and accounting rate of return. The capital budgeting, the advantages of IRR over net present value is that it gives percentage return, which is easy to understand at all levels of management. The discount rate, required rate of return, does not have to be known to calculate IRR. It does have to be decided upon sometimes because IRR must be compared with something. The discussion as to what is an acceptable rate of return can, however, be left until much later stage. In a NPV calculation, net present value calculation, the discount rate must be specified prior to any calculation being performed. So the advantages of NPV over IRR, you can go through it. The timing of the cash flow is critical for determining the project value below the line of cash investment or above the line of returns. The evaluation of any project depends upon the magnitude of the cash flow, the timing, and the discount rate. The discount rate is highly subjective. The higher the rate, the less a rupee in the future would be worth today. The risk of the project should determine the discount rate. Now, budget, quantitative expression of management objective, budgets and standards, budgetary control, cash budget. Profit planning is budget and budgetary control, marginal costing, CVP and break-even point, comparative cost analysis. Pricing decisions, full cost pricing, conversion cost pricing, marginal cost pricing, and market based. Pricing decisions, you can go through it. Conversion cost pricing, pricing decisions, operating leverage and financial leverage, you can go through it. Working capital, now this is a very important topic on this PPT which you really need to focus on because a lot of questions will be asked from this. Current asset lets current liabilities at net working capital or net current assets. Permanent working capital versus variable working capital. Now cash has to be greater, or in fact cash, raw material, work in progress, finished goods, sales, debtors, and cash comes as the part of working capital requirement. Operating cycle is the length of time between outlay of the wages, others, and inflow of cash from the sale of the goods. So matching approach to asset financing. So this is the time, this is the fixed assets, this is permanent current assets, and this is fluctuating current assets, total assets, short-term debt, long-term debt plus equity capital. The working capital cycle, operating cycles, you require the cash, then you purchase raw material. This is accounts payable. then value addition, then finished goods, then sales, accounts receivables, then back to cash. And this is how the operating cycle works. The company's operating cycle typically consists of three primary activities: purchasing resources, producing the product, distributing or selling the product. These activities create funds flow that are both unsynchronized and certain. Unsynchronized because cash disbursement, for example, payment for resource purchases, usually take place before cash receipts. They are uncertain because future sales and costs, which generate respective receipts and disbursements, cannot be forecasted with complete accuracy. So, these are the factors which determine the working capital: nature of the industry, demand of the industry, cash requirement, nature of business, manufacturing time, volume of sales, terms of purchase and sales, inventory turnover, business cycle, current asset requirement, production cycle. Working capital determinants: credit control, inflation, profit planning, repayment, cash reserves, operation efficiency, change in technology, firms' finance and dividend policy, attitude towards risk. So types of working capital. Basic concept is gross working capital, net working capital on the basis of time, permanent fixed working capital, regular working capital, reserve working capital. Now, working capital levels in different industries. A retailing company usually has high level of finished goods stocks and very low levels of debtors. Most of the retail sales will be for cash, and an independent credit card company or a financial subsidiary of the retail business. The retailing company, however, usually has high level of creditors. It pays its supplies after an agreed period of credit. The level of working capital required, therefore, low. So excess of current assets over current liabilities are called net working capital or net current assets. Working capital is really what a part of the long-term finance is locked in and used for supporting current activities. The balance sheet definition of working capital is meaningful only as indication of the firm's current solvency in repaying its creditors. When firms speak of shortage of working capital, they in fact possibly imply scarcity of cash resources. In fund flow analysis, an increase in working capital as conventionally defined represents employment or application of fund. In contrast, a manufacturing company will require relatively high level of working capital with investment in raw material, work in progress, and finished goods stocks, and with high level of debtors. The credit terms offered on the sales and taken on purchase will be influenced by the normal contractual arrangements in the industry. So, working capital, these are the things which form the working capital requirement. You can go through it. It is necessary to prepare a cash budget where minimum balance needed for month to month will be defined. So you can pause the video and you can just go through this slide. Debtors also play a very important role. Working capital, how it's established. Optimum level of investment in trade and receivable. Working capital factoring is defined as a continuing legal relationship between financial institution, the factor, and the business concern, the client. The selling goods or providing services to trade customers on open account basis whereby the factor purchases the client book debts. Account receivables, either with or without recourse to the client, and relation thereto controls the credit extended to the customers and administers the sales ledger. It is outright purchase of credit approved accounts receivables with the factor assuming bad debt losses. Factoring provides sales accounting services, uses of finance, and protection against bad debts. Factoring is a process of invoice discounting by which capital market agencies purchase all trade debts and offer resources against them. The factor manages the sales ledger of client company. The client will be saved of the administrative cost of bookkeeping, invoicing, credit control, and debt collection. The factor uses his computer system to render the sales ledger administration service. So different kinds of factor services. You can go through it. What are the benefits of factoring? You can pause the video and you can go through it. You can also download the copy of this PPT in PDF format and the link which I have provided in the description box below, which will be very helpful for quick revision. This is a very important PPT which conveys and has a lot of valuable information. Factors influencing inventory management, cost of working capital, disadvantages of redundant or excess working capital. These are some of the examples. And if you like this video, you can press the like button, subscribe to our channel, and share it on social media. Help us to spread education in this beautiful world. Thank you.